What is the ROI on Social Security? You've paid taxes into the system your whole working career. Now, as you near the time to collect your benefit, was it all worth it? What is the return that you will receive on your taxes paid in? That's what we're going to discuss in today's video, and the answer might just surprise you. First, Social Security is a system in which the taxes you pay in are immediately paid out to retirees. Now, you pay in 6.2% of your paycheck, and your employer matches this for a total of 12.4% of your income paid in. Then, to calculate just how large your benefit is, the Social Security Administration will take your 35 highest earning years. Now, as we discuss the ROI of Social Security, we're going to walk through two case studies. Here's the first. On the left-hand side of the screen, you see this person's working income in today's dollars through their working career. This person had some great income growth during their life, and their average income throughout was $60,000. Because Social Security is a flat tax, your situation will look fairly similar if your average income was around the same mark. Throughout this person's life, they paid in a total of $90,688 in Social Security taxes. Putting all of this information into the benefit formula, this person's monthly benefit at full retirement age would be $2,337. Now, we're going to look at this person as being 62 this year in 2024. Their full retirement age is at age 67, so they will receive $2,337 per month if they file at age 67. If they file sooner than 67, they'll receive a permanent reduction in benefits all the way down to 30% at age 62. If they delay past 67, they receive a permanent increase in benefits up to a 24% increase. So we can see there is a real material gap between filing at age 62 and filing at age 70. Now, know that across the board, all benefits adjust annually to inflation, whether you're receiving benefits or you are delaying. Now, before getting into the hard ROI numbers, it's important to take a small tangent and talk about how your benefit is exactly calculated. The first step is the Social Security Administration takes your earnings history and then adjusts it to inflation factors. Social Security has an inflation factor table that they post annually that you can look at and adjust yourself if you so wanted to. Then we want to total up your highest 35 inflation-adjusted earning years, and that's going to give you a big number, likely in the multi-millions. To get something called your average monthly index earnings, which I'll refer to as AMI, you need to divide by 420, which is how many months there are in 35 years. In the example on the screen, this monthly number would be almost $8,400. You then are going to plug this number into a benefit formula. Social Security is designed to replace a certain level of this income. One thing that is important to understand, like most tax programs in America, Social Security is a progressive tax system. It provides more benefit to lower earners. The first $1,174 of your AMI receives a 90% replacement rate. The next $5,900 receives a 32% replacement rate, and then everything over this receives a 15% replacement rate. So you could increase this example AMI by $1,000, but the benefit difference would only be $150 in terms of that monthly benefit. This is an important observation in the ROI of Social Security. A lower earner who is paid into the system less will ultimately receive a higher ROI than someone who had significant income and paid a lot into the system. Now, again, this isn't surprising. This is exactly what a progressive tax system is. Now, as we look at finding the return on investment of your Social Security benefit, we're going to be using a cash flow calculation. We're going to think about taxes paid in as if they are a contribution, and then we're going to think about the income you receive in retirement as if it was a withdrawal. Said simply, if you receive more income than you contributed, you will have a positive ROI on Social Security. If you pay in more taxes than you end up receiving for income, then obviously your return would be negative. To what degree this ROI will be will depend on how much income you receive relative to the taxes paid in. Simple enough. So let's look at the ROI in this case study. On the table, I have 3 variations in filing times, and then I broke out the ROI based on when this person within this case study might potentially pass away. Highlighted in orange would be the expected ROI range based on the life expectancy of someone who is 62. The first thing that we notice is when looking at the taxes you paid in, the ROI of Social Security is actually pretty reasonable. The expected return on just your side of taxes, what you actually paid in, is in the 6.5% to 7.5% range if you have a similar situation to this case study. Live long enough and this return can rise well above 8%. But there is a point worth noting here. An argument can be made that you should look at the ROI of Social Security based on the total taxes paid in, meaning both what you paid in as well as what your employer matched. After all, Social Security taxes are a part of a cost of having an employee. If Social Security taxes didn't exist, then that employer could otherwise pay you extra, or that extra 6.2% in taxes directly to you, meaning that your earnings would be higher. The last line in this table shows the ROI based on the full 12.4% in taxes paid in. Here we see the return drops into a more modest 4.5% to 6% range. Now, looking at this chart, a common mistake that some will make is thinking that you should make Social Security decisions based on the highest ROI based on a given life expectancy. If this was a conclusion you were taking away, you would think that almost no one should file at age 70 because you'd have to live past age 90 for that to give you the highest ROI relative to the other filing strategies. This would be the wrong conclusion to derive from this analysis. Within filing for Social Security, we have to look at our filing strategy holistically. Social Security is an income stream. Now, there are other assets and income streams that you probably have as a part of your retirement picture. As just one example, we need to consider a steady return our portfolio can earn. Now, the word steady is important here in retirement income planning. Here's why. Let's say you have a 100% stock portfolio for your retirement portfolio and it's earning 9%. Well, that's likely to be a volatile 9%. When you're taking income from a volatile portfolio, volatility absolutely demolishes the return that you end up earning. Here's a quick example. Say your portfolio loses 50%. Okay, well, we know that you need to make 100% to get back to break even. But let's say you were withdrawing from your portfolio during this time period and your withdrawals furthered that drawdown to 60%. To recover from a 60% drawdown, you would now need to make 150% to get back to break even. So really you should be comparing the return of either the safe side of your portfolio, or you can compare it to the return of your entire portfolio if the expected volatility is low enough. Given this expected return, we actually want to run a net present value calculation using this return as what's called a discount rate. This would be a more correct way to run a break-even analysis. Now, say we were running a net present value calculation with a 5% discount rate. We'd actually find that at age 85, that delaying to 70 would win out amongst the other strategies. The break-even for delaying to 70 is typically in your early 80s, depending on that discount rate. I want to make sure this is understood, as many watching this video will jump to the wrong conclusion based on these ROI numbers. But let's put this on hold. Let's jump to case study number 2. Now, this is for a high earner, and this person's average earnings were $124,000 through their working career, at least in terms of how much was taxed by Social Security. Ever since 1996, this person has been at the wage cap for Social Security, meaning that they would hit the maximum amount of taxes paid in on Social Security for more than 2 decades. Total taxes paid in were almost $200,000, and their monthly benefit at full retirement age would be $3,655. Now, jumping to the ROI table, we see a very apparent lowering of ROIs immediately. The return on your side of taxes paid in this situation drops about 1 to 1.5% across the board. The expected returns are in the 5 to 6% range, and the top end of the return on taxes paid in is near 7.5%. We see the same drop in ROIs when we look at both the total taxes paid in by you and your employer. The ROI on Social Security in this context is far lower and in a range where if someone could opt out of Social Security and instead retain those tax dollars, most high earners would probably opt out of Social Security based on these numbers. A prudent investor should be able to achieve a return higher than 3 to 4% on their own. And we already touched on why this is the case. At higher levels of income, yes, your AMI does go up, but the replacement rate falls drastically. You end up paying in quite a bit more in taxes to receive a very marginal benefit improvement. For instance, between our 2 examples, the higher earner paid in double the amount of taxes for only a 50% increase in monthly Social Security benefits. Again, this is expected in a progressive tax system. Now, let's cover some takeaways from this analysis. First, the ROI on taxes paid into Social Security can actually be quite reasonable for certain retirees, specifically for those that had lower earnings throughout their working career. For instance, if you just filled up the lower band on the bend points that I showed earlier, then Social Security can effectively replace 90% of your working income, and the ROI would be quite high. With higher earners, the ROI isn't exactly as great. The second thing to note, in certain situations, your ROI can be higher than really any of the numbers I've shown. Let me give you an example. Say you are married and you had one spouse that worked and the other spouse that didn't. That non-working spouse is eligible to receive up to 50% of your full retirement age benefit, even though they never paid taxes into the system. If this closely resembles your situation, then the ROI on taxes paid in can actually be quite substantial, because there's basically another 50% of your benefits that will be paid out based on the taxes that you paid in. Then finally, know that this presentation has very little planning impact and it's just more of an interesting analysis. Most people don't have the choice for how much to pay in for Social Security taxes. So it's not like you can look at this analysis and either opt out of Social Security or buy more Social Security income if you like the ROI. So again, it's primarily for informational purposes. Now, if you're someone who's wanting to look for some real world planning impact, then really the focus should be on the best time for you to file based on your situation. I have 2 videos right here that can help in this effort. Number 1, why you should file at age 70, and the other 3 reasons to file at 62, and then 3 myths. Click on these 2 videos to learn more, and always remember, you don't need more money. You need a better plan. Thanks so much for watching. We look forward to seeing you in the next video.